Well, welcome everybody to our Bay Area Housing Market Town Hall. Today is November 11th, and we are very excited about today's topic because we're going to be going over about partnership, whether you should do syndication or joint venture. And we have our special guest today, Jeff Lerman. I'm sure a lot of people know who Jeff Lerman is. But before we start, I always would love to start with introducing who we are. You know, the whole purpose of our webinar here is to make sure that we share information with our consumers to bridge that information gap so that you are also being educated and being empowered when you come to buying your real estate. Well, today is November 11th, it's Veterans Day. Yesterday, actually, it was the United States Marine Corps' birthday. I don't know if you guys know that. My husband was, well, he is still a Marine, although he is no longer active Marine, but he, once a Marine, forever a Marine, right? But I really want to use this opportunity to say thank you to all the veterans for all your services. I know how difficult it is. Every time I think about the time when my husband was deployed, it still brings tears to my eyes. And it's not only the sacrifice our military personnel have done for us, for our country, their family members as well have done a lot, have gone through a lot of sacrifice. Our family has been very big supporter for this Travis Manion Foundation. And this foundation was created by Travis Manion, who was killed in Iraq during one of his mission. And before he left, actually, his family member asked him, why are you doing that? Why are you volunteering to go to Iraq war? And he said that if not me, then who? That has become the quote for the foundation. And to be honest with you, here's a picture of my husband walking away to his third tour, or maybe second tour, I cannot remember, his third tour. And at the time we asked the same question too. Asked him, why are you guys going, volunteering your time to go to the war? And same thing, he's like, if not me, then who? So I just really want to take this opportunity to share and hopefully we all can, say thank you to our service member for the sacrifice and also their family members as well. We are so proud to be their sponsor, Travis Manion Foundation, and it's been probably about for the last 5 years minimum that we've been sponsoring them, and it has been a really great experience whenever we go to their gala in Pennsylvania, and it's been an amazing experience. So if you guys are interested, please go to their website, just Travis Manion Foundation, and check out their program, what they're doing for our veterans. So I know I took up a lot of time already, and I know you guys all really want to listen to Jeff regarding the syndication and joint venture. And as most of you know, he is a very, very unusual lawyer. We call him a real estate investor's lawyer. He's recognized nationwide, and he has done a lot of interviews and also workshop regarding syndication and joint venture. So I want to welcome Jeff to speak to you guys.
All right, let me get down to it. So you've already seen the introduction. Let me go straight into the presentation. What we're going to be talking about today is how to raise money for your next deal without breaking the bank and without violating the securities laws. And we're going to be talking about syndications versus joint venture. A quick disclaimer, because I am an attorney, the seminar is offered with the understanding that neither myself nor our firm, Lerman Law Partners, is engaged in offering you legal or other professional advice, and we have no attorney-client relationship with you solely by your receipt of this information. Any actions with regard to the information contained in the seminar should be undertaken only upon the advice and counsel of competent legal, tax, and estate planning professionals. So first thing I want to discuss is why I am speaking on this topic. This actually is my favorite topic, primarily because this is something that many investors don't understand, what a joint venture is and why it is an alternative to syndication. We do syndications and joint ventures at our firm, so we can help you either way. But I teach this topic around the country, and every time I do, the audience does not know what I'm about to teach you. And I think it's important for you to know so that you can have information to make good decisions. What we will cover today is investors' biggest challenges, why this is so important for all investors, the biggest problem with using other people's money, the biggest problem with syndication, the JV solution, the difference between a JV and syndication, why I believe JVs are the cheapest, easiest, fastest, and safest way to do OPM deals, and my special gifts for you, plus Q&A at the end. If you want a copy of my slides, just send me an email to jeff@lermanlaw.com. I don't want you to waste time trying to copy down the slides unless there's something that I'm discussing that's not on the slides. I want you to just listen and get what I'm saying. Let's discuss. What are your biggest challenges as a real estate investor? Is it that you're too busy with your day job to prospect for deals? That's my biggest challenge. I am a full-time lawyer, but I'm also a real estate investor, and I don't have time every day to sift through hundreds of deals to find the one deal that makes sense. And so when I do joint ventures, and most of the deals I do are joint ventures for myself, although I also do syndications for myself. Sometimes I do both of them in the same deal, a syndication and a joint venture. But I do most of my deals with other people who find the deals, and then I come to the deal with the money and the expertise and the legal aspects and whatnot. Is it that you can't find that needle in the haystack investment that makes economic sense? Is it that you're fully invested in other deals? Is it that you don't have a proof of funds letter to have your offers taken seriously? Is it that you don't have the down payment to buy new properties? Is it that you can't qualify for the loan you need to buy properties? Is it that you can't afford to keep your current properties? These are the most common challenges that I hear my clients discuss, and the reasons that they come to me to try to get some assistance in making their deals happen. You may have other challenges, but the point is that each and every one of these challenges, I believe, can be addressed with the right joint venture arrangement. So the biggest problem with using OPM. The biggest problem with OPM, in my opinion, is that the Securities Exchange Commission is involved and the securities laws. And because of the way most people do deals with other people's money, they usually do syndication. And syndication, when you do a syndication, that is governed by the securities laws. So in addition to the securities laws, it's more expensive to do syndication than joint ventures. Joint ventures are a fraction of the cost of syndication. Going back to the securities laws, the most important rule to make sure that you raise money in compliance with Regulation D, Rule 506B of the securities laws, which traditionally is the most popular exemption that investors use when they do syndication, is that before you can pitch your OPM deal to anybody, you must have what's referred to as a pre-existing substantive relationship with the offeree. That's the magic phrase, a pre-existing substantive relationship. But those words have specific definitions and specific meanings under the securities laws. It's important that you understand them. Most investors don't. Let's go through them quickly. First of all, what makes a relationship pre-existing? According to the SEC, what makes a relationship pre-existing is that it is one that the issuer, that's you, has formed with an offeree, that's your prospective investor, prior to the commencement of the securities offering. That's the key phrase, prior to the commencement of the securities offering. But therein lies another term which we need to define. When is a securities offering deemed commenced? So again, according to the SEC, an offering is commenced once a deal is contemplated. For example, under contract. After then, it's too late. So understand this because it's really important. The typical sequence that investors follow is they will put a deal under contract, and then they will go and look for the money. But if they wait until they have put the deal under contract, at that point, it's too late to make an offering to a prospective investor and stay in compliance with the securities laws. And therein lies a huge, huge problem. Now let's talk about what a substantive relationship means, because that is another aspect that could be problematic for investors, for the issuers. What makes a relationship substantive? According to the SEC, a substantive relationship is one in which the issuer or a person acting on its behalf, so they're referring to either you, or if you're working with a broker dealer, that would be a person acting on your behalf, has sufficient information to evaluate and does in fact evaluate. You can't just think that you have the information, but you have to actually evaluate it. A prospective offeree's financial circumstances and sophistication in determining his or her status as an accredited or sophisticated investor. So it's not enough if you know somebody and you think they might have enough expertise, enough if they're accredited or sophisticated. You actually have to document the fact that you have evaluated that and you understand it, and you have proof in case the SEC ever takes a look at your offering. So these rules are important. If you do not comply with these rules, then a court could rule and order you to refund to your investor, all your investors, the investment that they made with you. But by that point in time, you may have already spent the money they gave you, may have already bought the deal. And investors rarely complain when the deal is going well. Usually, the way this is going to come under the radar of the SEC is when a deal does not perform as expected and the investor complains, and they somehow get the SEC involved. And at that point, it's going to be very difficult, if not impossible, for you to come up with the money to make that refund. Or you can also have criminal sanctions. Think Bernie Madoff. You can go to prison for violating the securities laws. So when I teach this topic, and I do in front of at private money boot camps and at other seminars, webinars, whatever, invariably, the same question comes up at the break, and somebody will come up to me and they will say, I have a deal under contract now. I need money now. What do I do now? Because they realize, based upon what I just explained to you, that it's too late for them to go and get the money they need from strangers, because these people, they show up at these events, and one of the main reasons they do is to try to find investors for their deals. They come to these private money events hoping to find somebody to invest, but at that point, these are strangers. They don't have a pre-existing or substantive relationship with them. And so this is a problem, although they usually don't look like this. They usually look like this because it's pretty stressful. I've spoken to investors who literally have hundreds of thousands of dollars in earnest money that has already gone hard on a deal. And the reason they came to these private money events is to find investors. And if they can't find an investor, they're going to lose hundreds of thousands of dollars. So this is serious. And whenever I see this, my heart goes out to these people, because just imagine that kind of impact it has on them financially. So this is why this is something that I'm passionate about, because this is something that you need to understand is an alternative. So what I tell them is what I'm going to tell you, which is, even if you can't do a syndication, you can get the money you need through a joint venture. The stakes are high. If you do it right, then the rewards can be substantial. But if you do it wrong, you could go to jail. So the summary of syndication problems is this: it's too expensive, it's too complicated, it's too risky, it takes too long, and there's not enough pre-existing substantive relationships for a lot of people to do a syndication. So, solution, let's talk about joint ventures. But not just joint ventures with the right partner. And not just joint ventures with the right partner, joint ventures with the right partner that have been properly set up. I can tell you that at our firm, we're litigators as well as transactional lawyers. and we have litigated partner disputes. And I can tell you that every partner dispute that we've litigated could have been avoided if the joint venture had been set up correctly from the beginning. And when I mean set up correctly, making sure that what we do with people who are coming in for joint ventures, we talk to them both in person or on a Zoom, but we make visual contact. And we ask them a series of hard questions that they're going to need to decide before they go forward. And if we feel like they're not a good fit for each other, we will tell them that they have to give it second thought and maybe go back and talk about some of the harder questions. But the other thing is to make sure that the document, the joint venture document, is prepared correctly, the joint venture agreement. And every time we've had a dispute that ended up in litigation, it was because the joint venture agreement had a defect in it. So what this is about, joint ventures, this is about actively engaged partners. When I'm talking about joint ventures, that's what I'm talking about. Joint venture typically is defined as the coming together of two or more people for a common business purpose. That's a general description of what a joint venture is. But specifically what I'm talking about as an alternative to syndication, as a way to raise money for a deal, I'm talking about when you have a partner who is actively engaged in the deal and has sufficient real estate experience, so that they are not relying solely on you to make a profit. This is not complicated, people. These are 2, 3 basic requirements for a joint venture. Actively engaged partners with enough real estate experience so they're not relying solely on you to make a profit. But this is essential that you understand this, because people think that they can get around these or somehow fudge these, but these are the requirements of a joint venture. If you have those, then it's not a security. It's not a security. It's not governed by securities laws. What this is not about is partnerships with passive investors. Passive investors are defined under securities laws as if you have an investor, all they're doing is writing you a check, giving you money, and expecting you to make them a profit. That's a passive investor. This is not about syndication. This is about joint ventures, and this is not about securities laws. If you have a joint venture, the securities laws do not apply. So let me tell you why I believe that the cheapest, easiest, fastest, and safest way to overcome your investing challenges and finally reach your real estate success goals is with joint ventures. I believe it's the cheapest because it is a fraction of the cost of syndication, first of all. And that means that you can stretch your dollars. Everybody's on a budget, so everybody wants to save money. And if you work with a joint venture partner, as opposed to what I see a lot of people doing, is putting all the money in the deal themselves. And that's their philosophy for building their portfolio. But I can tell you, if that's you, if that's how you're doing your deals, then you are drastically limiting the number of deals you can do, because as I see often, these people, they have to hold on to the deal until they sell the deal, and then they get the money, and then they can do the next deal. So if you start doing deals with other people's money and joint venture partners, you can stretch your dollars and you can seed more deals. Why do I think joint ventures are the easiest? Because think about it. For all of you out there who are already investors, and even those who aren't yet, but they've heard about it, there is so much to do when you are a real estate investor. You have to sift through dozens of deals to find one. You have to analyze the deal. You have to do the due diligence. You have to find the loan, deal with the lender, find the money, manage the asset, manage the manager. And this is just the few items that I could think of off the top of my head. There's a lot more. But when you think about that, it seems like it is impossible to get it all done if you're on your own. But if you are doing a joint venture, you have what I refer to as partner power. And all of a sudden, you have a partner who's helping you get all those to-do items done in a deal. And it makes it so much easier to actually get deals done. Why do I say it's the fastest? Because think about it. If you're doing a deal with your own money, it's going to take you that much longer to build your portfolio. If you start doing deals with other people's money and with joint venture partners, then you can build your portfolio faster. Why do I say this? It's the safest way to do a deal. Because if you do a joint venture, there's no worries about what you can say. You can say anything to a potential joint venture partner. You don't have to worry about inadvertently making a securities offer and making a securities offer that's not in compliance with the securities laws. You don't have to worry about who you can say it to. You can say it to anybody. You can discuss it with anybody. You don't have to worry if they're accredited or non-accredited. And if you're doing a syndication, that is something that you have to worry about. You don't have to worry about when you can say it. You can say it anytime, even after you sign the purchase contract. As a matter of fact, you can bring in a joint venture partner to an existing deal of yours, even after you already own the deal. So no worries about when you can say you could say it. You could bring in a joint venture partner at any point in time. And no worries about the securities laws. So for those of you who are still doing all deals with your own money, think about investing 101, which is diversification. If you're putting all your deals in one basket, all your money, if you're putting all your money in one deal, then you are not diversifying. So what you could do if you're doing deals with other people's money, with joint venture partners, then you could diversify by asset class, whether you want to go with apartments or office or land, or diversify your risk with that. You can diversify by geography. If you don't like California, go outside California like we have done. You can diversify your risk. Lots of ways you can diversify. Now, let me give you a case study to demonstrate what I think is probably one of, in addition to everything I've talked to you about, there are other aspects, there are other benefits of doing a deal with joint ventures. And the best way I can describe it is with this case study. So I had a client back in 2012. It was actually back in November 2012. And this client had a deal under contract. This client had started, it was a short sale they were buying, and they had worked that deal since February of that year. And it took that long for the bank for them to cut the deal with the bank. And finally, they cut the deal with the bank, and they were ready to close in November of 2012. And back in November 2012, we didn't know, we were involved still in the last downturn. And at that point, we didn't know when the economy was going to turn around. And so the client came to me and said, you know what? This economy is going through this situation which we've never seen before. We don't know when it's going to turn around. I'm not sure that it makes sense for me to do this deal, even though it's a short sale. And I said, well, look, you've already got this much time into it. Before you walk away from it, why don't you try to find a joint venture partner and see if you could find somebody else who thinks the deal is a good deal and can get you more comfortable with it. And he said, at that point, he had never done that before. I said, you know what, give it a try. And so when he went to the joint venture partner, the partner said, you know what, I think the economy is bottomed out, and I think that we're going to see it bounce back pretty soon. And the joint venture partner said, look, I will put in 50% of the deal, and we could be partners on the deal. And so as a result of that, my client went ahead and he did the deal with that joint venture partner. Now, what ended up happening, for those of you who might remember, back then in January of 2013 is when the economy started to bounce back, literally a month after they closed the deal. And within 6 months, the deal they bought doubled in value. Now, that happy ending is almost irrelevant to the story because that's not the point. The point is that what a joint venture partner can do is, first of all, give you the opinion of an equally sophisticated real estate investor to give you another perspective and to perhaps make you feel more comfortable in taking a risk. And secondly, it is all about risk tolerance when it comes to real estate investing. All of us need to understand what our risk tolerance level is, but all of us also need to understand that maybe we might be too risk averse. I myself had to deal with that over the course of my career in investing as a real estate investor. As a real estate lawyer, I am hardwired to be more conservative and anticipate everything that can go wrong. But over the years, through my dealings with joint venture partners, my risk tolerance level has gone up, and I'm willing to risk more these days than I did when I first started investing. And that made all the difference in the success that we've had in our investing. So I'm not saying that is going to be something that you should do, but I think that it is important that you understand that your risk tolerance level is going to play a big role in your investing career. And I encourage you to explore that and decide what is a good risk tolerance level that you can live with. And doing that with a joint venture partner is a great way to do it. Find somebody who you respect, and maybe they can help you take higher risk in this business. But also getting somebody who's actually going to put hard money in the deal, significant hard money in the deal. Their opinion on the deal means a lot more than if you're doing a syndication. If you're doing a syndication on a deal, if my client was syndicating that deal, he's not going to be able to ask his investors if he should do the deal. That would kill the deal right off the bat. So there's a whole different relationship between you and a joint venture partner than there is between you and investors in your syndication. And in addition to everything else, that client and that joint venture partner started doing more deals together, and that partner ended up being a source of other deals. So this is something, these are the other benefits that go along to joint ventures, is you can get more deal flow, you can get another opinion from somebody who you respect, you can maybe modify your risk tolerance level, and you mitigate your risk. If the deal hadn't gone well, at least my client only was going to lose 50% of what he otherwise would have lost if he did the deal himself. So to summarize, the benefits of a JV are to get a second opinion from the investor who is able to put his money where his mouth is, as opposed to just getting opinions of consultants. The incredible input to help you reevaluate your risk assessment for this and future deals. Getting the deal done instead of passing, or making you feel better about passing on the deal if that's your decision. Getting a new relationship that will yield more deal flow and more done deals, and give you better risk diversification in your portfolio. So that's why I'm such a big fan of joint ventures. So bottom line, I think what joint ventures do is give you more peace of mind in the investing business. Now, for those of you who still aren't convinced, let me just finish with this quote from the Wall Street Journal article. A growing player in the real estate market is the so-called family office, in which an ultra-high net worth family, typically with more than $100 million in assets, joins with another wealthy family to buy investment property. Despite having ample cash, so get this, these are two family offices with more than $100 million in assets. They're doing joint ventures not because they need the money. They're doing it for all the other reasons that I was just explaining to you. Despite having ample cash, these families are looking for partnerships in order to lessen their exposure to risk. If real estate values were to tank, for instance, losses would be spread out over at least two parties rather than one family incurring the entire hit. Some family offices with expertise in housing look for partners that have built their wealth in other sectors. Others seek out real estate investors with a similar background in order to combine their expertise. So for example, you might be up with a joint venture partner because you are a multifamily investor, but you want to now get into self-storage. So maybe you want to partner up with somebody who knows self-storage. Or maybe you want to partner up with somebody who has more experience in multifamily than you do. Either way, they bring value to the deal over and above the money. Partnering up can help a family office get regional diversification. That's what we talked about before, being able to, maybe you're just used to investing in California, but now you want to invest in another state. Find somebody who knows that state. That way, if a market takes a turn locally, the family still have rental income from other locations. So I ask you, if the journal, which is read by the most successful people in the country, it writes a story that says that the most successful people in the country are using this strategy, joint ventures, to invest in real estate, doesn't it make sense for you to consider it as well? That's all I'm asking. So I believe that ultimately joint ventures can be the key to your success in the real estate investing business. Now, before we do Q&A, I want to end with a gift to all of you. We have two special reports. One is called 17 Steps to a Successful Joint Venture, and the other is 12 Warning Signs You're Headed for a Lawsuit with Your Partner. Now, both of these are based upon my 40 years of experience. These are things that I have observed as strategies that have worked. None of the joint ventures that we have set up have ended up in a dispute, let alone ended up in litigation. So I think that's because of the unique way that we set up our joint ventures and the unique way that we deal with our clients in making sure that they are mitigating their risk going into it. The 12 warning signs you're headed for a lawsuit with your partner. I want for my clients to keep you out of court, even though I'm a litigator and I'm here to help you if you do end up in court. My objective is that you will never end up in court as a result of anything that we do. So with these two special reports, I think both of these will help you in getting more investments and staying out of court. So if you want these gifts, all you got to do is send an email to me at jeff@lermanlaw.com. And with that, I apologize for the amount of time we took, but now if Helen, you want to read some questions, I'm happy to take questions.
Absolutely. We have until 5:15, so we still have 18 minutes to answer some questions.
And one other thing I want to mention, because by the way, you did a phenomenal job on your market update. I see a lot of market updates, and that is the best one I've seen. I thought it was a terrific job. Thank
you so much. Yeah, definitely a lot of research going into that.
I can tell. In addition to this, we at our office can help you, and we're seeing a lot of work come through our door for commercial lease restructuring, commercial lease renegotiation. So if you're a landlord or a tenant, we can help you with that. And we're seeing a lot of people who are buying and selling commercial property, and we're also helping people who are buying and selling residential. If they don't have a broker involved, then we get involved more than if they do have a broker involved, but we can help either way. So I just wanted to mention that.
Great. So yeah, we do have some questions here. So let me go ahead and read out some questions. I'm going to start with some questions that for Jeff. Which money is better to use for syndications? Money from taxable accounts or self-directed IRA? Pros and cons of using money from the two different types of accounts. Are there any tax benefits, tax write-offs for any fees, expenses, etc., using money from taxable accounts?
Okay, so nice question. I have to tell you that what I tell all my clients, and it's in our engagement agreement, we don't give tax advice, and I have to defer to your tax advisor, to your CPA. If you don't have, if you don't have a CPA who has a good, strong knowledge of real estate, because some CPAs do have more than others. We deal with a lot of CPAs, and we're happy to make an introduction for you, but we don't give tax advice.
Absolutely. That will be the same answers I give to my clients as well when they ask me this question. Greg, I know I want to get back to your question, is that does a loan that was in forbearance that is now reperforming mean that all deferred interest has been repaid in full? So usually forbearance that they have their own agreement, each bank could be different. So it really depends on how they structure it. So unfortunately, I cannot really answer that question because I don't know what they have negotiated with the bank.
Yeah, and as long as you're talking about forbearance, and I know we're going a little bit back and forth on this, but if you're a landlord, don't do what I have seen other landlords do. You cannot begin a negotiation with the tenant in this COVID environment without, there are certain things that you have to do, and if you don't do them up front, then you can't go back and do it. So you should definitely talk to either your lawyer. If you don't have a lawyer, then we're happy to help you.
Yes, as a matter of fact, just a couple episodes ago, we had an attorney to be on our show to talk about that as well. There are a lot of process that you have to follow, otherwise you'll get into huge trouble.
Right.
All right. And Paul asked, can you talk more about partners' participation in a JV? I still believe all partners have to be active and non-passive. In other words, is enough to be the money partner only, for example?
No, it's not. So let me give, this is one of the most common questions I get. And I find the best way to explain, to give you an answer, is to give you another example of an actual situation. I was involved in a joint venture. There were four of us, and it was a residential subdivision development deal. And so we had the person who found the deal and who got the loan, and then we had the developer, and then we had a broker involved who was involved in the design and the marketing of the finished product. And we had me, I handled the legal, and I brought the money to the deal. And so each one of us filled a unique portion of that particular project. And in addition, we all did a weekly conference call, and we had a secretary that took notes during that call. And during that call, we discussed all the issues that were going up, and the secretary took copious notes saying, okay, Jeff asked about this, and Sam thought that, and we really got very specific as far as making sure it was clear the role that everybody was playing, and it wasn't just sitting back and letting other people make all the decisions. And so the takeaway from that is, yeah, you can have as many people in the deal as the deal can be actively engaged in that kind of situation. Now, a residential subdivision, any development deal is going to be easier to bring in people to do different parts. If you have, for example, a land deal where there's not much to do, that gets a little bit more complicated. So that's something that it's always going to be a question of fact. But I give you the example I gave to show you that everybody should be actively engaged and not just sitting back. And it's actually in California, there's actually a corporations code statute which says it's not sufficient if all you're doing is voting on other people's decisions. Mm-hmm. So that is, hopefully that helps you understand better what it means to be actively engaged, because there is no SEC definition of actively engaged. The only thing the SEC says is somebody who's actively engaged is somebody who's not passive. So it's very, the SEC leaves it broad and wide open so that the SEC is not hamstrung when they want to determine if somebody was actively engaged or not.
Is there, as a matter of fact, is there a minimum number of people or maximum number of people for a joint venture? Because syndication, obviously, sometimes it can go up to 50, 100 people, right, for syndication. Right. What about joint venture? Is there like a maximum number? It's,
again, always going to be the extent to which you can demonstrate that everybody was actively engaged. It's always going to be a question of fact. And this, again, is where, if you're going to do this, it's really important for you to work with a lawyer who's got experience in this, so the lawyer can ask the kind of questions and understand the answers to say, okay, I think that's, I can't guarantee, but I think based upon my experience that this should pass muster in case the SEC ever takes a look at it.
Right.
It's always going to be a question of fact.
Sure. All right. And Greg asked, what entity structure do you recommend for a joint venture?
Well, usually it's going to be an LLC. That's the most, that's the one that usually works. You could do a limited partnership as well, but that is problematic. So for purposes of this context, if you want, we could have a deeper discussion if you have a particular deal you want to talk about, but it's going to be an LLC.
Great. And Leon, he asked, can you talk about the best way to invest in this market with high housing prices? I can answer that question. To be honest with you, in the high housing prices area like Bay Area, there are still a lot of good area that you can invest in, but we always look for areas that has a potential more value adding. For example, there are areas downtown San Jose, they have a lot of developments. They are still expensive, relatively speaking, compared to a lot of other places, but they have definitely, we can see growth in there because they have the BART that is going to have their second extension probably in 10 years or so. And also the Google campus obviously is building over there, and downtown San Jose has tons of developments over there. So when you look at these areas, I always look at, I call it emerging market, and even maybe outside of the core area. For example, one of the most popular areas that our clients are going into is Stockton, because at first people are afraid to go in there, but at the same time we can see the growth, potential growth in that city, and that's why actually it's been working really well for our clients.
That's a topic you and I should talk about when you come on and I do my interview with you. For everybody, we're going to be so Helen and I know each other for a while, and we're going to feature Helen on a webinar next year in January, at the end of January. One of the things you should talk about are the emerging markets, because that is a topic which is going to be hot.
Yes,
so,
absolutely. Yeah,
okay.
I love that. All right, Leon also has another question. What's the best way for two people to hold title that are not married? I guess we kind of talk about it, LLC.
Well, to hold title, so you're talking more about vesting. I mean, we could talk about entity as well, but if it's vesting, so the default in California's matter of statute is tenants in common. If you and I did a deal together, Helen, and we just went on title then, and we didn't have any kind of a joint tenancy arrangement, the default is going to be tenants common. But if you do tenants in common, everybody listen to this because it's important. If you don't, you need to have a TIC agreement, because if you are doing a deal with somebody else, there are important terms that need to be discussed and agreed upon, because if you don't, then the statute's going to decide for you, and you may not like what the statute says. So, the specific question you had is, what's the best way to take title? Now, you can do an LLC, but that's another conversation. But yeah, an LLC would be a good way to do it.
Right. All right. And Samuel asks, relative to 1031 exchange, does JV work the same way as TIC?
Well, so if you want to do if you want to be plan for a potential 1031, here's what you need to understand. If you're in an LLC, then what you can do is at least 1 year before you sell the property, you can drop out of the LLC into a tenancy in common, and that way you can go your separate ways and have maximum flexibility. If you don't do that and you're still in an LLC, you can still do a 1031 exchange, but you are joined at the hip at that point. And so that's something that we discuss with our clients at the beginning, because sometimes you don't always know when you are 1 year away from selling the property. So that's a planning decision that needs to be made.
Absolutely. And Winnie asked, what are some are the most common disputes that you see in a JV?
Well, I will tell you the most common one. The biggest warning sign, and this goes back to my special report, 12 warning signs you're headed for a lawsuit with your partner. So I'll give you another quick story on that one. So I had a client, two clients who are partners, and he calls me up one day and he says, I got a problem. I came to the office and my partner changed the locks. I can't get into my office. And I said, why did he do that? He says, well, when I called him up, he said, this is what I had to do to get your attention. So like any, a joint venture is a business marriage. And like any marriage, communication is important. And that is the biggest warning sign that you're headed for a lawsuit with your partner, is when that communication starts to break down. And starting to break down, it happens a long way before it actually breaks down. You can start telling just in a difference in tone or the amount of time you spend speaking. I will personally, I was in a joint venture. I am in a joint venture with somebody who I knew for decades. And when we started out, it was great and whatnot. And then something happened and I was a little upset. And so, I didn't tell him about it. And he said, "Is everything okay?" And I said, "Yeah." And then, like a week later, I thought, you know what? I teach this stuff. I can't do this. And so I called him up and I said, "You know what? Everything's not okay. Let me tell you what kind of, let's have a conversation." And I told him what it was that was kind of getting me ticked off. And we discussed it, we got through it, we got past it, and we're still partners today, we're still friends today. But hey, it can happen.
Yeah.
No matter how much you know, you're still human. And if you're in doing a deal together, there's always going to be a potential disagreement. The significance may vary, but there's always going to be a disagreement. So just remind yourself, don't be afraid or ashamed or just not want to deal with it, because you're going to have to deal with it some way or the other, and you don't want it to get to the point where it gets beyond the ability to resolve it. And so you need to take the responsibility, and if there's an issue, have a cordial conversation about it. And it may be difficult, but that's, it's always going to be difficult.
Yeah. And I always say that joint venture, I mean, it's great you have a contract, but at the end of the day, you really need to do some due diligence with the partner that you're partnering with, whether if that person is ethical or not, have high integrity, because sometimes you have a contract, but then if you partner with the wrong person, that can eventually still hurt you, despite having that contract, right? So hopefully, if you do find a partner, just have to find it very carefully.
That's part of what we do when we're working with a client on this, is we give them a number of things that they need to do, apropos what you were just saying, to check out their partner. I'll give you one other example. I was talking to a friend of mine who I hadn't seen in a while, and he wanted me to partner with him on a deal. And I was out to lunch with him, and I said, "Sure, but I'm interested, but I will tell you that I always do a investigation on somebody I'm going to do business with, because I just want to know who I'm getting in bed with." And I said, I do a litigation search. I don't do a full-on investigation, but I do a litigation search. And so I said, it's been a while since we've spoken. Have you been involved in any lawsuits, or are you involved in any lawsuits? And he said, "Well, I just a couple eviction, nothing big." I said, "Okay, good." And as soon as I got back to my office, it took me 5 minutes to do a litigation search. And I saw that he had been a plaintiff or defendant, a party to 69 different lawsuits, 69 different lawsuits. And I called him up and I said, "Gary, I got to tell you, there's no way that I could ever do business with somebody." And he was also a lawyer, by the way. And I said, "There's no way that I could do business with somebody who either gets sued that much or finds it or goes to court that much, is so comfortable going to court as a way to resolve a dispute."
Yeah.
So I said, "Let's just stay friends, and I'm going to pass on the deal." So that's one of the things that I always tell my clients to do, is do a litigation search, because it takes 5 minutes and it doesn't cost a thing. So that's one of the things I can teach you how to do.
That's great advice. I know we have 1 minute. Let me try to see if we can squeeze in these 3 questions. How do you go about finding a partner investor for a joint venture? I actually thought, if you want to find a partner or investor to do a joint venture, you need to prepare a good presentation to pitch about your deal. Because honestly, I always think that if you find a good deal, it's easy to find a partner, because people do have money, they do want to invest. Jeff, do you have any other advice?
Yeah. First of all, you're looking at one right now. A lot of the reason, seriously, a lot of the reason I go to all the events I go to is because I'm looking for my next joint venture partner. We probably have people in the audience here who go to the same event I go. There's a company out in Boston called Real Estate Mentor. And I used to teach their private money boot camp, and I go to their networking events. And I went a few years ago, and I met somebody there who had a deal, and we just sat down, had a cup of coffee, talked about it. And then it was in Tennessee, in Nashville. And I went to go take a look at the deal, and I liked it. And within 30 days, we did the deal. So that's another thing that I like about joint ventures, which is that it could be a lot faster I brought all the money to that deal. So instead of having to try to raise money from 100 people, putting in $50,000 a piece, all that she had to do was take that one meeting with me, and all I had to do is take that one meeting with her, and she got all the money she needed for the deal. That could be you. I mean, all it took was one meeting, and we got it done in 30 days. If you do a syndication, it can take you 30 days to get your syndication ready to go to market, depending on your particular deal and how long it takes for you to get me the information I need to put together your private placement memorandum. So that's another benefit of joint ventures.
Absolutely. I know we are past 5:15. Jeff, I don't know if you still have time to answer some of these questions. I know some people might start logging off, but we do have a few questions left.
I'm fine.
Okay.
Sure.
All right. So next question is like, can you 1031 into a JV? Can a family member be a tenant in a 1031 if they pay market rate rent?
I am going to defer to a CPA, or you can also call the exchange accommodators. I can tell you one that there are a number of different ones. I work with IPX 1031, and if you want, I can give you the name of somebody who's there. You probably also know exchange accommodators, right, Helen?
Absolutely, I have quite a few that are very good. And
so just call Helen. She can direct you to somebody that she likes.
Absolutely. All right, and the next question: what is the best entity for construction projects with joint venture?
And by the way, I'm sorry, before we move on from that last one, you would be surprised, as I was, what can constitute a like-kind exchange. So I think that's a good conversation, whoever asked that question, for you to have, is to, you'll learn something if you talk to that exchange accommodator. I'm sorry, what was that last question you read?
What is the best entity for construction projects with joint venture?
Well, it's for the entity question is as much and I know this is going to get old here, but it's as much a tax-driven decision as it is legal. We can set up any entity that you need in order to get the deal done. But what I tell people, especially for construction, that might be, it depends on how long you plan on holding the property. Also for you fix and flippers, I know a lot of fix and flippers might want, their CPA might say, you know what, a sub S corp is the best way for you to hold your fix and flip deals. So so what I do with clients is say, look, talk to your CPA. You tell the CPA what kind of deal you want to do. Tell them everything. Give them all the information they need, and they're going to make a recommendation based upon the tax consequences, because that is the real driver in these decisions. I mean, if I disagree or if I question what the CPA told them, then what I will do is I will suggest that we get on a conference call, me, the CPA, and you, the client, and we have a conversation so I can understand it. And whenever that happens, we always end up agreeing upon it. So that's the way to do it. There is a tax. You need a team. All of you who are investors, you need a team. You need a broker. You need a CPA. You need a real estate lawyer. You need somebody who can help you with your syndication or joint ventures. You need there are others, but those are the main people, I believe.
Yeah.
Helen, maybe there are other people on the team that you think
I mean, like
should.
a property manager, if they're plan on leasing it out, right? And also their contractors, but definitely building a team is essential for any real estate investments, especially like that. Those questions, a lot of times people just ask the CPA or ask attorney, and then the CPA was like, oh, well, we have to talk to your attorney. So it's kind of intertwined. Everybody needs to like talk to each other in order to make the best decision for you. So it's kind of hard to just ask one person.
Right.
And RC asks, how do you do litigation search? Is it just Google?
It depends on the county and the city. In that story I gave you, it was easy for me to go online to the court website, and you just can put in the name that you're trying to search, and you will see how many lawsuits they've been involved with. Other counties or other cities may charge a nominal fee for you to get that kind of access, but it's a nominal fee. But that's, so if it's, and sometimes you may have to look in more than one city and more than one county, depending on where you are. But in that particular story I gave you, I was in Los Angeles at that time. He was in San Diego. I went into the San Diego court website, and literally in 5 minutes, I just typed in his name, boom, it just came 69.
And that's only in San Diego. Who knows?
And that was only in San Diego, exactly. Yeah. If I would have looked in Los Angeles, I'm sure I would have seen more, because he used to live in LA.
Oh gosh, that is scary if you have to work with somebody who just, I think besides doing this litigation professionally, he seems to be doing that as a hobby as well. So.
Yeah.
And Leon asks, how do you work out the percentages when you do a JV?
You know, great question. And like so many things in real estate, it's one of the things I like about real estate is there's tons of creativity and flexibility. And to this day, I've been doing this for 40 years, and I still see structures. People come to me with structures that I haven't seen before. And just when I think I've seen it all, somebody says, well, here's an idea. I say, oh, that's an interesting idea. So yeah, I mean, it's going to end up being a process whereby you have to understand what everybody is bringing to the table and what value there is. And it's not just money. It's money, it's expertise, it's relationships, it is time, it is, I mean, those are the factors, the main factors that come to my mind. There's others as well. And so this is an important part, a really important part of setting up the joint venture correctly, because one of the most common mistakes I see investors make, which comes back to be a problem later, is a lot of times people will come into a deal and they won't negotiate for as much as they should have gotten. For example, maybe somebody will say, you know what, I'll handle the management because I just, I want to be a good partner. And that's great that you want to be a good partner, but I'm going to be the first one to tell you, don't give away your time, because I guarantee you that at some point you start putting in all that time and you're going to ask yourself, geez, I'm doing all this and I'm not getting paid. And just because you tried to do the right thing and be a good person, whatever. But that's another topic that we have a discussion about at the front end of the deal. I want to make sure that a lot of times people, because they're friends or want to go in being a nice person, and I think they give away too much. So part of what I do is I really want to make sure that everybody is making a fair deal for themselves.
Yeah, that's great. You sometimes have to have somebody to look at it objectively to give you some advice, especially if you have done so many deals, so you can definitely give them great suggestions.
Yeah. And by the way, for all you, just because you do a syndication doesn't mean you're not going to have a problem. Before I got on this webinar, I was having a conversation with somebody, and he was telling me that he's got a problem because he's got a syndication, and he's got this one investor who has been the biggest pain and has gotten to the point where the threatening lawsuit, and it's, that's not unusual. And I can tell you other stories where the same thing happens. So don't think that if you do a syndication that you're not going to have to worry about dealing with other people involved in your deal.
That is a very good point. Very good point. And Leon has last question is like, do you think the person finding the deal, doing the deal is worth an equal percentage with the person providing the money? I guess that's kind of what we had talked about, but at the same time, it's again, case by case situation.
Yeah, really.
You really have to talk to Jeff.
It really is, just like real estate is unique, every deal's unique. And so these are all great questions. And again, it underscores, I got to tell you, the number of times we've handled disputes either that went to litigation or just got resolved in mediation. And when people have put their deal together without a lawyer, that's when these problems arise. So please work with your lawyer. And if you don't have a lawyer, we're here to help you. We're right here in the Bay Area. So happy to help you with this and keep you out of court.
Thank you so much, Jeff. This has been such a wonderful session. We went way over, but at the same time, it was just like a very interesting topic. I think this can help a lot of investors who just started to invest to find ways to, step into this real estate investment. So if you guys do have any questions at all, feel free to reach out to Jeff. Jeff, do you want to share your contact information again?
Yep, it is Jeff at Lerman Law, LERMAN law.com. And yeah, I mean, as I started out saying, this is my favorite topic because I feel like there is so much value that I can provide to keep you safe and to save you a ton of money. Because if you end up in litigation, I guarantee you that it is any money, any corners you try to cut by saving on setting it up correctly, you will end up spending exponentially more having to deal with a problem. So please, if you're going to do this, make sure you have a good team.
Yes, absolutely. Again, thank you so much, everyone, for staying over time with us. And I hope that you guys can come back next time. And be sure to check out Jeff Lerman's website. He has tons of information on his website. And I am just so happy and excited that this time Jeff is on our webinar and town hall to answer some of your questions. Thank you so much. Have a good night. Bye.
Thank you. Bye-bye.
I hope you enjoyed our webinar. That was a lot of information, and I am so grateful for Jeff Lerman to be on our show this week. And I hope that you guys will come back. Next month, we're going to have another very interesting topic to help you with your real estate investment decisions. So please stay tuned and don't forget to subscribe to our channel and also click like if you like the content that we are sharing with you. Thank you so much. See you soon. Bye.